I'm Teneale.
And I'm Kelsey, and we're financial advisors from Allman Partners True Wealth, bringing you thought-provoking conversations around you, your money and your life on the Wealth Experience podcast.
Welcome back to Wealth Experience, where we break down the financial truths that matter and help you make smarter, calmer decisions about your wealth. I'm Teneale, and today we're talking about what has transpired before. Let's get some good learning lessons from wealth lessons from market history. Okay, so because there's one thing history teaches us, it is this: markets do reward the patient and they punish the reactive. I'm in the studio alone today, so I'm going to try and take you through this lesson as best I can. Please bear with me. All right, we're going to walk through the major market movements that have shaped investing, what they mean for your financial future, and why staying invested, especially when it feels its hardest, is one of the most powerful wealth strategies available to you. So I thought we'd start off today's session with a question, and that is, why do we look at market history at all? I know when we're talking to new clients, we always say that, previous market performance is not indicative of what's going to happen in the future, and that is very true. We don't have the crystal ball, but one thing that is true is that human behavior doesn't tend to change. Fear, greed, optimism, panic, they all seem to show up in predictable ways over and over again. And we know this, when markets go through big rallies, people get excited, they want to invest money. When markets go through downturns and economic growth slows, or we go into recessions, people feel more reluctant to invest. They might want to take their money out. So we know that there's a level of emotion that's always attached to investing because humans go through emotion. But what we also know is that markets show a very predictable pattern throughout this. They rise over time, they fall occasionally, but in the long term, they reward long-term discipline. Now, every generation thinks that their crisis is the one that's unprecedented. And we do see this very often when we're talking about the past and about market turmoil. The two most common market phenomenon that I tend to hear come out of investors' mouths is the global financial crisis and COVID-19. And that kind of makes sense. They're relatively new phenomenon in that even though the global financial crisis was now about 2 decades ago, it was still a major impact and to the current generations of investors. But there are many, many more examples from prior generations before this. Now, if we're thinking about some of these, they're things like the big ones that come to mind are things like the Great Depression. This is where markets also fell by 35% and was recorded as one of the longest, most severe market collapses in history. And I'm sure that our listeners right now are thinking, oh yeah, I've heard of that, or may even remember grandparents or great-grandparents' stories of what life was like in the decade from 1929 when the Great Depression came about. But here's another one. And I don't expect most people to know about this one. It was called Tulip Mania, and it was just 1 year back in 1636. It occurred in the Dutch Republic when the price of tulip bulbs surged to extraordinary levels due to pretty much speculative trading. Sometimes rare bulbs were even reportedly as much as a house in terms of their total costs. It seems kind of unfathomable that something that's going to wilt and die was able to create such extraordinary amounts of speculation. But what actually happened was when buyers suddenly lost confidence, the market collapsed almost overnight and wiped out fortunes. It's considered as one of the world's first recorded speculative bubbles, and with prices being driven not by the intrinsic value of the assets, but purely by hype and social frenzy. It's such an interesting bubble, in my opinion, and really it caused massive amounts of financial losses, but it didn't have any long-term national economic collapse, like many other collapses did have. And we've seen similar bubbles again in the future, things like the dot-com bubble of the late 1990s. Many people will remember that one. But if we compare and contrast that to the global financial crisis, which caused deep structural, financial damage, and COVID, which had the broadest societal impact but the shortest financial downturn. And what you might be finding interesting is that all of these events were inherently different in nature, which is their unpredictability factor, but they are expected. What history does say is that cycles repeat. We just give them different names.
Want to invest your hard-earned money but don't know where to start? Allman Partners True Wealth presents AP Direct Invest, your online self-directed investment solution. Choose from 6 low-cost exchange-traded fund portfolios, including 2 socially responsible options. To manage your own investment experience, visit allman.com.au/AP Direct Invest and start your investment journey today. AP Direct Invest, your investment solution. Any financial product advice is general advice only and may not be appropriate for you. Always read the PDS.
So, from the late 1970s oil crisis to the 1987 crash to the dot-com bubble, then the global financial crisis, then COVID-19 crash, each really felt like the end of something. Each dominated the headlines and created mass amounts of fear and panic. But the outcome was always the same: recovery, followed by growth. Imagine if you sold out during any of those downturns. What you would have actually missed that extraordinary recovery period that followed. In fact, in the first year after the Great Depression, the S&P 500 index returns were positive 49.98% in 1933. There were returns of positive 28.36 in 2003 after the dot-com bubble, positive 26.46 following the global financial crisis in 2009, and 26.89% positive returns in 2021, which was the full calendar year in this case, after COVID-19. That's pretty astounding, right? And history teaches us this. It's not about avoiding the downturns. It's about staying emotionally strong enough to live through them and to not make wealth-destroying decisions. This is a core belief that we pass on to all investors that come to see us, because the data really is unquestionable. Missing even just a handful of the market's best days can dramatically reduce your long-term returns. And here's the catch: the best days often occur right after the worst days. In fact, after the single worst day on record in the Great Depression, just 2 days later was the single best day in the full 12 months that followed. 2 days. Imagine that. You've just gone through the worst market crash of that year in one day, and you're thinking it can't get this is terrible. It's not going to get better anytime soon. 2 days later was the biggest uplift that followed for the following 12 months. So trying to wait for things to settle means that you're almost guaranteed to miss that upswing, and we see it time and again because emotion becomes part of the equation. So if you think about the COVID-19 crash, global markets fell sharply over weeks, but they recovered at record speed. And for investors who stayed put, they benefited from one of the strongest rebounds in history. Those that waited for the all clear, they most likely missed out a significant portion of that recovery. And that's quantifiable differences. So over the past century, we've seen many new things. We've seen new industries blossom. We've seen innovation accelerate. I mean, look at the AI space. Look at the tech space. That's been incredible. So businesses have adapted, productivity's risen, global economies have expanded, and human ingenuity is the engine behind all of that long-term growth, really. So as long as we keep inventing, improving, evolving, markets will keep rewarding investors who stay the course. When you invest, you're not just betting on the stock market, you're investing in the progress of the human race. So let's do a little bit of a recap. What do we know? We know that volatility is normal. We know it's not a warning sign. Markets rise, they fall. It's not a flaw. It's part of how wealth is created. We know that staying invested is a superpower. It's simple. It's not always easy. That's where good advice and a solid plan comes in to keep you on course. And we know that your plans matter more than predictions. A solid investment philosophy is one that's grounded in evidence. Smart investors don't just chase fads, and they don't guess at the future. Having solid investment portfolios, which should be designed around these things, will give you the ability to weather the storm and capture those long-term returns. So let's talk a little bit about that emotional side of investing. Now, like we've been speaking about, market history doesn't just give us data, it gives us a lot more. It actually gives us some perspective. And when clients call and want to have a chat during volatile times, they're not really asking about what's happening in markets, even though they're saying, what does this mean for me? What's next? Should I be selling? What should I be doing? What they're actually saying is they're asking for reassurance. They want to know, am I going to be okay? And that's the emotive side of it. And the answer is almost always tied back to discipline, patience, and staying aligned with the plan that's been created. History does give us the confidence to say, yes, you're going to be okay, because disciplined investors, not reactive ones, build lasting wealth. So that's it for today's episode, a journey through the big lessons that market history teaches us. And if you take away just one idea, let it be this: markets reward the long-term, disciplined investors. Thank you for joining me today on Wealth Experience. And if you've enjoyed today's episode, please subscribe, share it with someone who might need a reminder to stay the course, and join us next time as we unpack more insights to help you build a confident financial future. Until then, stay patient, stay focused, and stay invested.
The opinions of the presenters are objectively ascertainable and are not intended to be financial product or personal advice.